Yep. Thank you, Sheena.
Thanks, Sheena.
There is a lot of different opinions at Pitbull conference for sure. But yeah, does anybody
take a poll because there's so many different opinions? Are we in a recession? Or are we not in a recession? That seems to be the first question that a lot of people are asking these days.
Well, according to what they were talking about, John Hornick, he was saying how the bond yield is inverted, right? And so technically we're in a recession. But if you look at it, unemployment's, 3%, I believe, roughly. And like, it just doesn't make sense, right? But actually, John put out I was videoing his keynote speech here and there, and I caught a clip of him talking about that. Maybe I'll put it out there if I can find it. Maybe I'll even share screen right now and play it. But there's a lot of great insight there. It was just so hot. So everybody just stayed indoors. You would have loved it.
I love it. Sunshine, beach, sounds perfect.
Speedos.
Speedos, perfect. Chris and I hanging out at the beach in our Speedos.
You fit right in over there in South Beach.
Awesome. Should we start with leads, needs? Anybody got any needs? Got any leads?
Leads, good deeds. I wonder how much things have people have slowed down, because like the volume has decreased substantially. It sounds like from here talking to some of the other lenders at the conference. So is anybody mid escrow in buying something right now? Let's see who's on the call.
Anybody got their terms changed at the last minute because of all the changes that are going on and any deals that you're closing?
What about some of our clients, Kiko, your clients?
Well, our family is buying a 41 unit in Houston, and we've been in escrow 3 months now, and we've basically ridden the interest rate ride up. So every other day, I feel like there's a new information that says, oh, we're going to have to change this. And underwriting's getting tougher. I feel like they're asking for my kids' W-2 and Social Security too, who are, 13 years old, because they're trying to double check everything. So it's a lot rougher. It used to be where commercial lending was easy, because so long as your property had good income and you had good financials, then they largely underwrite based on that. But now lenders are looking, at least for multifamilies, they're even looking at the quality of the tenants that are in there. How many months have they been in there? What kind of leases do they have? Because they're trying to make sure that the risk that they're taking and lending on a certain asset is going to have the income continue. Because if a recession was to hit and got pretty crazy, then are these tenants in these class B and C neighborhoods, are they going to be losing jobs, to which then they're not going to pay rent, to which then the landlord's going to be short on income, which then mortgage payments may not get made. So it's quite an interesting thought process as you talk with underwriters, because gosh, the underwriters right now are even asking people to sign really unusual documents, kind of attesting that they don't know of any additional information that must be disclosed, which was interesting to me. In fact, we just had one of our clients sign it yesterday, and they're like, why would I sign this? Like, I don't know if there's more information because the seller hasn't disclosed it. And so I think the lenders are trying to make sure that they have every opportunity to come back at any information that may have been missing. So yeah, sorry, that's a long answer, but it's pretty interesting for sure.
No, they were talking a lot about that, setting expectations, being close to the clients, especially if like you're an originator, which we are. So yeah, they're asking, like, it seems like there's a big disconnect between the borrowers and the lenders, because you go to these conferences. The conference was kind of light, it's a lot of doom and gloom, because when the interest rate spiked so fast, there's a lot of people who just got stuck and they're upside down on the deals that they did. So the rates rose maybe within 30 days. Like it was, it jumped 100 to 200 basis points. And lately on the lender side, there was a lot more demand. So the lenders would have to, it was driving the market and the prices down. So the interest rates started going down from like 9 to 8 to 7, and then 7 at one point, and then they're 90% of the purchase, 100% of the renovation. It got so aggressive. I think normal hard money institutional capital should be around 85% of the purchase, 100% of the renovation, and 75% total LTV. I think that's normal for a healthy market environment for when it comes to private lending. But we dropped way below that. I think interest rates are like 9 and 2, I think is like a good base, 9%, 2 points. It's a good balance between mitigating the risk for the lenders and then also having an affordable capital for the borrowers. But anyways, and nobody has anything, no deals on the table. Tay, I saw Tay came on. I wonder if she ended up locking up the funding for her deal. Tay, are you still on? She might be in something. Okay, anyways. You're muted, bro.
I'm just talking to myself. You were stating earlier about the unemployment being low. I don't know if anyone else has got an opinion on that, but I feel like part of the reason why it's low is because there's a lot of people who didn't go back into the workforce, like all that senior population through COVID who was like, oh, you know what, I'm out. I personally have many relatives that were working but not working. And so then they're just like, we're out of the workforce. And then I don't feel like the unemployment rate takes into account the full-time and part-time. So, if you were formerly full-time and then COVID happened, you lost your job, but then now you're taking like an hourly 28 hours a week job just to make money, then that would be basically you're counted as employed, but yet you're not fully employed. So I feel like that's a really interesting read. And I'm not so sure that definitely is an accurate read of our economy, especially because the job rate growth isn't growing that fast. So something to me just doesn't make sense. And I don't feel like we're measuring it correctly. But that's just my take. I don't know if anyone else has got a take on that.
You know what someone mentioned is that they mentioned that there was a substantial amount of small businesses that got wiped out, right? And that took a lot of the job positions off the market too. So, but we still have 3%. Matt, you had something to add?
Yeah. Hey guys, nice to be here. This is my first time coming to the meeting. I wasn't sure what I was in for. I personally, just a little background, and I do want to weigh in on the accuracies of these measurements, which I'll do right away. Actually, I think the only accurate thing about these measurements is that they are inaccurate. So one thing I think, because you look at CPI, you look at all these things, what buckets are they pulling from? Like you're saying, Keikoa, what are they counting as far as these unemployment numbers? I have very little trust in a lot of these numbers that come out. I personally, just to give a little background, I was in the mortgage business for about 15, 16 years, and I left at pretty much the height of my career. I still have great connections with the gentleman I was working with, Brady Spangler, over here on Maui, and we're good buddies. He does a lot of great work. So if someone needs financing, let me know. He's a connector. But anyways, I got out of the business to get into crypto, blockchain technology full time. That's how I came upon you, Corey, or is it Techiopia? Yeah, Techiopia, right? And so and now I'm here. Anyways, that was my 2 cents on the numbers, and really glad to be here and just kind of listen and learn.
Yeah, man. Thank you for your insight too.
Yeah, you don't have to just listen. The fun part about Coffee Talk is that we set it up super informal as just a conversation, so we learn from each other. There aren't any experts. In fact, Corey and I would probably be the least experts on the entire call each week, but always
there's a lot of smart people in the room. And a
There's
lot of them
smart people, bro.
kind of
like we got to get Matt to share more about this blockchain, man. That stuff's the crypto stuff is amazing too.
Are you tying it into real estate at all? I mean, is it fintech? You're in the
I was kind of thinking that's where I was coming on this space. I thought I was going to be hearing about how you guys are doing it, which I'm happy to be here and hear about how the market is evolving from those that are on the ground in the real estate business, because I'm very interested, just, knowing where things are at in different areas. Yeah, there's some people, I haven't dug into that part of it. I have been on the grassroots on a daily basis, just learning as much as I possibly can what the technology is going to do in lots of markets. I've never really believed in something more in my life, but I'm also learning a ton. There's a lot to know about the tech, but how that can be leveraged for all these different arenas. Real estate will be one of them. I mean, look at the escrow side of things is very intriguing. How it's going to come into play with that is very intriguing, because you can have this immutable layer of the information to where you can know that, hey, this title information is here. It can't be manipulated, changed. I don't know that that's a big issue, but it's just interesting to know how this technology can be leveraged in a lot of different arenas.
Yeah, and I'm just surprised it hasn't already penetrated title and escrow, because it seems like it'll be perfect. But I guess, I mean, when were you in the mortgage industry, Matt? Were you in it during 2005 to 2009-ish?
I got in 2007 midway, I think, or 2008. So right around the crisis, and then, just went around, found different, I was with a broker, with retail, with broker, ended up with Guaranteed Rate, which is a fantastic organization. It just was not the direction I was wanting to go when I started learning more about but yeah, it's going to be interesting. It's a very nascent technology at this point. So it's very early, and there's a lot of learning and breaking of things, for a lack of a better term, to be done right now. So I understand why we don't have the onboarding yet, but it's coming. I've never believed in something more in my life. I got to be honest.
Well, it just makes sense. And because I know for a fact there's investors out there, and I know of one here in Honolulu that they know that they can fight some of the foreclosures indefinitely. So they'll fight the foreclosure. They'll do cash for keys to the owner. And it's not that much, but they'll give them he would offer them 15,000 to just walk away. And then he'll just take over the property, start renting it out. And then he'll get the foreclosure notices from whatever bank is claiming. But the reason why they can fight it is because back between the certain amount of years, right around that time, 2005, 2009, with the ninja loans and stuff, all those, they found that the loans got chopped up so many times. They've been sold different angles. Some banks went out of business. They can't track who actually is the note holder and who should be able to collect collateral. So the people who know this, they strategically look for properties that have mortgages back then, and then go into basically take over the property and fight the foreclosure indefinitely and put a renter in there. And I think the blockchain technology could have solved that problem, I think, and we've been able to track title and not have it be altered, right? So we don't have this mess where there's we have a friend of ours who was a mentor of ours who bought a property he bought it at auction with the previous owner in the property. And that owner was one of those guys that knew that he could fight the foreclosure indefinitely, and he has been. And I think he still is stuck with this property. He's had it since I've known him, for over a decade. So unfortunately, it's a big problem. So my advice is don't buy a property at auction if the owner is still living in there. You got to get them out first. Because if it's a tenant, perhaps you have more leverage. So it's not as catastrophic, but I wouldn't especially if you know that the bank, the loan they're trying to collect on was originated around that time, because maybe they can't track, so that he could fight it indefinitely and you're going to be stuck. So quick tip. Thanks for sharing, Matt. And thanks for coming on, man. It's always good to have new faces, new eyes and opinions. So
right on. Appreciate it.
Yeah. We got a lot of people on Maui on the call too. So hopefully you guys can link up, do business. Keiko, you got any updates on maybe what's going on with the Vegas deal that people can share so everybody can learn? What stage?
Right now, I think what we just discovered by accident is that as we were trying to get permits to renovate the laundry room, we discovered we could probably add 4 more buildings to the 8-acre property we have. So that's pretty game changing, especially in a recessional economy, is just to add to what you already have as opposed to trying to buy more stuff. So taking a look at that. Our insurance premium, just got a quote the other day. So in the midst of all this recessional economy stuff, and even insurance companies are adjusting their pricing, which is pretty shocking. So our insurance premium went from $20,000 a year. So we have 160 units, just went up to $99,000. So 4 times plus. So it's a little shocking, to be honest. So
yeah, I'd say so.
Gonna digest that one for a little while and see what some options are. But I get it. I mean, right now, if something was to burn, you have to replace it with today's construction costs, which are very, very high. And labor costs are very, very high, and supply chain issues. So I can see for an insurance company, what they're doing is just trying to figure out, what is the actual cost of what they're trying to cover. So that's interesting. We got some interesting stuff there. But
is it because something happened maybe on the property, because of there was a lot of incidents, right?
We had a murder, but I mean, why is that going to increase our insurance? I don't understand. But
no, but is that the reason why?
No, that's a different one. That's a different coverage. This is just purely property.
What coverage does that fall under?
I think that
liability.
Would that be other peril? No, hold on a second.
Where's our insurance guys on here? Can we get Kekoa some new insurance?
This is a really good company too, but yeah, I'm just reading it right now. I'm trying to figure out, they've got all these different lines. Insurance is hard to read, man. It's as hard to read as closing statements that nobody reads when you buy properties.
Yeah.
No, but that's going good. The one thing that I'm noticing though, as the market has changed a little bit, is that for those that are looking to get into the multifamily space, there are a lot of investors sitting out for right now. And so we actually now are noticing there are not multiple offers. There's no bidding wars in a lot of the resi, so 4 units and bigger. So we're looking at a couple of really large assets right now. And what used to be a competitive LOI, 4 or 5 million over list, is now like, hey, somebody bring us an LOI and you name your terms and let's see if we can make a deal. So the market's pivoted pretty quickly. So I think anybody who's ready to get into the multifamily space, or even any space for that matter, mobile homes, adult family homes, or any of those spaces, I think a lot of those assets now are going to become more accessible. So I think getting a really good lending partner in place, and then really having a plan, and then really understanding the pricing, so that way you're not overpaying. If the market was to correct some more, the way I look at it is that if I'm looking at an asset and I'm going to try to turn it in 6 months, I don't need to predict, what the market's going to do a year or 2 years from now. I just need to kind of predict what the next 6 months looks like. And then trying to say, hey, will it drop 5% in the next 6 months? Maybe. Will it go 10%? Maybe. Will it go 15? Maybe not. So somewhere between 10 and 15% decline is kind of my margin, for example. And so then I just try to get the property at 15 to 20% cheaper than I would have before. So if I would have bought it at 75% of ARV, now I'm making offers at 60% just in case the market slides like 15 more percent. And so that's kind of our approach right now in making offers. And surprisingly, there's actually sellers that are like, yeah, you know, hey, what else do you guys need as terms? So it's an interesting time. I don't know if anybody else is noticing that at all in the space that everyone's in, but interesting stuff. Sorry.
How has Vegas been? Vegas pulled back?
I would say that Vegas is still doing okay. I think right now, Houston actually, our appraisals are still coming in 6 figures above our purchase prices. So that's still looking really solid. So Houston, for some reason, the market's really, really strong. Vegas is okay. Washington, I feel like is a lot less competitive right now for some reason. Vegas is less competitive, but pricing is still strong.
Like, are you noticing days on market going up?
Yeah, lots of days on market going up.
Price
In fact,
drop.
I think what's really cool is I think a lot of people who are holding assets right now are saying, let me sell now before the market drops some more. So we're seeing a lot more new inventory come on as well. And that's fascinating to me because you got a lot of investors in these multifamilies. And that's why I say, you know, you could probably even make yourself a little deal because some of these investors who bought it, say 200,000, their fourplex is now worth 500. They're like, man, I better sell it for 450 before it drops more. But they have so much margin that, I mean, technically they may even be happy because their mindset is like, what if it's only worth 400 next month? So therefore you offer them 425 and they might, you know, take a bite at it if the numbers work for us.
Right. Yeah.
It's fascinating. I love it. We gotta spend more time helping each other think through this market. I'd be curious how Daniel's evaluating the market right now because I know Daniel's pretty active in buying.
You're in India, Daniel.
I am kind of in India. I mean, like we're doing looking for some commercial in India and Kansas City, but most of our focus is in Hawaii right now. And just I think we're seeing like a normalization of the market where it's going to be back to like, okay, you're not going to get like the 15 over ask, whatever. But I feel like my opinion is that there'll be more of like a leveling out where, okay, like markets, you have to put a really good product and you're going to get like a few offers on your house. It's not going to be crazy. You're not going to get like, you can't list at over ask. You have to list at the current comps. And then you'll be, as long as you're like the nice house on the block compared to the other comps, you'll get at the current comps. That's just kind of like my thought in Hawaii anyway. And so I think it's always market specific, right? So like your market is gonna be different than my market, etc. But I feel like in Hawaii, it'll be like that. I think we actually have we're sitting on a house right now where we thought we would get a few offers, but we're actually sitting right now on one of our properties. And I think maybe a price a little too high, and there's a few other things, but basically I think buyers can be a little bit more picky as far as like they're a little bit more reserved, I think, as far as like there's not a frenzy, like, you know, but it's your house will sell, just like you might take a little bit longer and you're gonna sell at the current comp price.
Yeah,
that's my thoughts.
Yeah, that makes sense, right? I mean, like the cost of capital basically doubled in a very quick time frame. So there's sticker shock, there's deals that were on the table that are no longer the borrowers can qualify for, right? So there's a lot of displacement that happened. So, but it is interesting. Hawaii, I mean, it always holds strong, very strong appreciating market. But when you look across nationwide during the time of the inflated price, like housing prices, Hawaii actually appreciated like what, 20%, I believe, in the year. I mean, I say only, right? But I mean, it's still like crazy. But you look nationwide, I mean, like Tampa was like almost 40%. There, you know, some markets was over 50%. It's insane. So, but Hawaii, which is known to, you know, I mean, we're short supply and we're high demand. So I would have thought our values would have went up faster. But you know what, though? It shows how strong our market is because you look at Tampa, they went up 40% almost, but they're coming down pretty fast too now, right? So my point is, because they're asking about, you know, I had the opportunity and the privilege to fill in for one of our friends who kind of didn't get, or he had to bail last minute. It was actually Rich Katz of Rodeo. he really deserved to be on the panel because he's like years of experience, and but before I got to go up there and speak, and they were talking about the disconnect between the lenders and the clients, right? And I said, that's why like these calls are so important, because we can kind of help link the two, because we know the conversation and what's going on closer on the money side. And then also, have a pulse on the borrower side, because we're borrowers too. And we can be that conduit, and right now they notice that there's a disconnect. And for me, I was saying, like, I think as long as we set expectations with our clients, like, it's an opportunity for all of us to get closer with our clients. Because if this continues to, slow down and we head into a recession and all that, then really it's going to clear the field, for the guys who know how to play in this type of market, right? Who know the fundamentals, who have the resources and the liquidity to sustain them through a turn. And like, let's focus on the people who want to continue to invest and is willing to take the risk, and let's double down on them, because that's really the space is shrinking anyways. There's half the volume is being done right now, is what the stats are showing when it comes to investment properties, is that it's the volume slowing down across the board.
Yeah, I feel like demand is definitely coming down. It just matters on where your supply is in your market compared to the decrease in demand, right? So the guaranteed demand is going down, but is your supply also like increasing, or is it staying steady, or is it even decreasing, right? And so one of the things we have going for us as like the interest rates rise is that because the interest rates are going up now, people can't sell. I mean, they don't want to move out because they don't want to lose out like that. They don't want to lose a interest that they already have locked in, right? So if you have a 2.5% interest rate, you don't want to sell the house and then try and buy another like 6% interest rate. And there's other guys who are like, they can't, because if they're to sell the $1 million house, now they can only afford like a $700,000 house. And so like that artificially also keeps supply down in certain situations too. And so like, just the big, but I mean, so guaranteed the demand's going down, but is supply staying steady, or is it increasing, or is it going down in your market, right? So where is this level, this thing like going towards, right? So
exactly, I think there's so much key points in there. And because I was thinking, like, if you know that your market, like Hawaii, Honolulu, went up 20% during the time of like the inflated prices, then you know that there's fake equity there. How much fake equity is what we have to ask ourselves, right? And some people have suggested, we're just whatever that time frame was, we're going to take that off of our ARBs now. So 20%, that's a big shaving. Like, you may not compete then, and I don't think you have to take off the whole amount, right? Because like you said, there's other factors that are in play here that are affecting our space, right? Like people not putting their houses on the market, which still keeps the supply low, right? Because they know that they may not be able to afford another house. And two, like even if they afford it, it's going to cost them a lot because the rates are super high. So you're right. I mean, that's another
small thing is this is where like good realtors also shine. I think because like honestly, in the past like couple of years, like any realtor can sell a house because you just throw in the market and you're gonna get 15 they're asking. But now like we're working with Ashley, right? So like now like you have to like reverse call like the buyers. There's a whole bunch of things, little subtle things where now there's little subtle things make a difference as far as to like if your house is going to sell and for house and for what price, right? So like now this is like going to kind of weed out like just like the brand new realtors who are just kind of like, if you list it, it's going to sell like over asking guaranteed. But now it's like, hey, now there's some nuances where like the skill set of the realtor actually comes into play in this type of market, or if the market is going to drop too, right? So shout out to Ashley. Thank you for being a rock star for us, Ashley. Appreciate you.
Woo-hoo, Ashley.
Pick up of Daniel's comments, all great points. And another thing is that as these rates raise, people can't qualify. So the qualification is much harder, because rule of thumb is you got to show that you're making twice what your monthly bills are going to be at the end of the day. And so as that rate goes higher and the prices, sure, there'll be that kind of balancing a little bit, but it does take some people off the table as far as being eligible buyers.
Yeah. Yep. Yep. So that's why I was like, if Honolulu kind of went up by 20% in the year and you know that there's some fake equity, maybe you shave 10%, maybe take half of that, 10% off of whatever ARV is showing now, right? And that's only if you're buying right now, because things may change, right? Like things might start to stabilize and then rates start to even go down. I mean, John Hornick, who's our attorney, he represents pretty much all the big firms in the hard money space. And his prediction is that, you're already starting to see it, like kind of like stabilize. But he said he believes by the end of the fall, rates will be stabilized. And by early next year, rates will start to go down. So he's very like optimistic. And I can tell he was holding back a little bit about saying why, because he was very confident when he was saying it, but he didn't want to quite say why. And I think it's because he's a politician too. Like he's a mayor of New Jersey, Marlboro, New Jersey. And so he gets a lot of information ahead of a lot of people, right? So the message was that things are looking good. It might be short-term pain, long-term gain. Like this is how it is. So, and that gives me confidence because someone like him, there's no agenda, so.
For the valuation too, like I would, like how I'm doing it in our market right now is like, if it's a luxury property, I'm going back 5 years. So I'm looking at the COVID 2 years, and then I kind of come up with, okay, well, what happened in that subsidiary market in these past 2 years? And what did that look like? But what was the 2 to 3 years before COVID? And what did that look like? And then I just kind of compare those days on market to the random influx. Cause I feel like these last 2 years is just, I don't feel like you can really just piggyback on those with certain price points or certain properties. And then just look at the history. And then I kind of go like, okay, these are the trends this subsidiary market is likely to fall back into, unless if that particular market all of a sudden attracted a whole new demographic of people, then obviously you have to make a shift for that and consideration for that as well. Or if something new had developed in that neighborhood in the last couple of years. And then and I think I'm doing that with all price points to some degree or some level. And then, but for that below luxury price point, to your point, just, taking, if it went up 20%, then pricing with shaving off 5-10+% with keeping that in mind. But something that I'm recognizing in our market, and I don't know if this is what other people are experiencing too, is that the level of crime has gone up exponentially and the level of homelessness in neighborhoods have gone up exponentially. So just making sure when you're looking at deals too, like what is that surrounding neighborhood looking like? Because now people are going back to, honestly, I don't feel the emergent need to purchase right now. So if I don't feel comfortable with something, they're just not going to do it. And we're seeing that in all different like houses, multiple listings getting broken into, squatters showing up in the process of renovation or getting it, pre-listed, people living outside the houses. And this is all price points, all areas. And I think I'm seeing that, I'm hearing that with realtors across the nation and all, because I think that the issue with homeless is becoming a national issue. But for people who are looking at like how to price the house, just keep that in mind that maybe you're not going to go back in the last year and just count for that, because the days on market are also going to be a variable. So going back pre-COVID market and using that and piggybacking and blending the two.
Yeah, it's an unfortunate situation. Like when the economy goes down, it really does. It really means lives are at stake, unfortunately. So like you can start to see it, on the streets, more people who are homeless and stuff like. So when it says recession, it's like to a lot of people, it might mean like, times are going to get tight and, it's going to be a little harder. We got to work a little harder and maybe spend less or go out less but we forget that let's not forget that a recession to some mean like life or death, or like maybe street, being on the streets or having a roof over your head. So, and some markets are going to be affected more than others, especially the ones that kind of had the big spike. Boise seems like it's getting a big pullback too. Places in Utah as well. So I think knowing the market that you're in is now more than ever like key fundamentals. But I think hopefully for the investors, like for us, some of us who came in during COVID, like right in 2019, 2020, when COVID happened, like we got a little taste of what it was like, like I know on the financing side and the lender side, like there's companies that just did not come back, and this one feels kind of the same, but it's more of a longer, it's a slow burn on this one, and unfortunately it was a light room, but there was some great content there. And what I learned overall is that no matter what level you're at, because some of these guys they're market movers in the private lending space. And that means even in the real estate space for which we play, a lot of the decisions that they make affect all of us. Like there's a few guys who are pioneers in there, like John Beecham from Turok. They're a publicly traded company. They're KKR. They're a big note buyer and big investor. Big capital provider for a lot of your lenders that you guys probably know, and when you got him and maybe the CEO of Rock Capital, Eric, he's another pioneer. These guys brought Wall Street into our space, like they were really little guys. There's like a good handful of them who are still there. And it's just kind of, I guess, humbling to see them on stage having the same conversation we're having here. It's what do you guys think? Well, what about this? What about that? Right? It's the same. Like this is a very unusual time, and I think the way we get through it is collectively together, right? So it's kind of humbling to see, titans of industry kind of scratching their heads too, disagreeing, kind of debating each other. Yeah, I learned a lot, and I hope I can share some clips, because there's some good ones I got on my phone. So if I find it, I'll post it in Keiko Exchange. That way you guys can check it out. But does anybody have anything they want to bring up? I mean, it sounds like, is everybody kind of taking a pause? I know Daniel's still investing. We got Ben's still investing. Ben, have you bought anything recently?
No, definitely looking though. Always looking, just being a little more conservative on the numbers. It's a little bit difficult here in the Seattle area. Just prices are so high, and trying to, like we talked about, I think maybe 2 or 3 weeks ago, just making the money going in, being really conservative.
Yeah.
Because that's how you don't get caught out when the market drops, 5, 10, 15% when you go to turn it around.
Yeah. Yeah. And I guess because you were doing BRRRRs too, right? And BRRRRs, and you're buying rentals.
And that's really hard.
Yeah.
I mean, that was really hard to make it work when the interest rates were good.
Yeah.
So yeah, that's, unless you got a screaming deal, it's pretty much kind of evaporated at this point. Or if you got something creative, like, if you can come in and have, maybe it's a single family home and you can put like a accessory dwelling unit on it or something, so you can get more than one unit out of it. Those kinds of things are probably still workable. Those are always harder to find. You got to be real creative, but just buying something, fixing it up, and then, doing a BRRRR on it, it's just real hard to make the numbers work with how high our purchase prices still are versus rent. I mean, our rents are high too, but it's just not very balanced here. I know that strategy works a lot better in other parts of the country. So I think probably what I'd be picking up around this time is probably more like flips,
Yeah.
Maybe some small multi or something like that on the rental side of things. But yeah, I think like single family burrs, at least in our market, are pretty thin right now.
Yeah. Yeah. It was already getting thin, right? And then now the interest rate spike and the recent, appreciation or, jump in the prices, the DSCR loan space just got slaughtered overnight. Like DSCR was the hot topic. Everyone was selling DSCR loans. They were just loving it. And the rates were getting more aggressive. Leverage was getting more aggressive. Like we were down to 3.25% on a DSCR loan, like that, not conventional financing. Like and then, then the rate started going up. So DSCR I want to know if anyone's closed a DSCR loan in the last month. I highly doubt it.
I have.
Oh, okay. Was that
they don't care
for a client or for yourself, Leo?
Clients, they don't care what the interest rate is as long as it's debt servicing out. They will take the interest rate all day long. In fact, I have one right now that we're trying to make it work, and we might have to go in for an exception because it's a 2.5 unit purchase in Colina, 50% down, but the HOA fees and the taxes are so high that we can't hit the 1.10. We're actually at 1.082.
Oh man. Okay. I mean,
this is putting the interest rate all the way down to 7%, buying it at 4 points.
Oh no. Oh no.
But I will tell you there are more and more of them coming into NewFi recently, and that has a lot to do with the DFI literally targeting any lender that is not licensed and any loan officer that's not licensed doing these in the state of Hawaii. They put a complete kibosh on it. So, and
you have to be right. You have to be a resident too, right?
There's a little bit of a gray line, but the best way I say it is whatever the DFI says, we don't ruffle feathers, just go along with what they say. I mean, there's technically documentation within the CFPB that says it's an exempt transaction because it's a non-residential property. It's a rental property. But once again, you just throw your hands in there, say, okay, that's fine. I understand. But there are a lot of them, and we are seeing more and more of the properties that are listed on the county's short-term rental lists. So a lot of properties in Maui, we're seeing a lot of properties on the Big Island, not so much in Honolulu. But Ko'olina, that's all short-term rental available. So we're going to start seeing more and more of those too.
Lehua, can you do condotel?
Yeah. Like I said, the one in Ko'olina right now is a condotel.
I might have one for
yeah.
Maybe I'll send you an email or something.
Yeah, our condotels, we require 25% down. Okay. So that's less than the local banks. Local banks require 30% down.
Yeah.
But we also do condotel for national, and we're doing all of those DSCR. We're actually trying to put something together on, where Soda Bowl is? That new condominium that's coming up?
Yep.
One of my brokers, her husband's a developer and knows the guys doing that building. So we're trying to see if we can actually do something for bulk closing, 60 to 80 units for Korean foreign national investors on DSCRs.
On DSCR, it'll be all DSCR. So what is your guys' minimum DSCR then? Is it 1.0?
We can actually go below 1.0, but not on the condotels, not on the foreign national. Rule of thumb, I would say stick somewhere around 0.75. And then you'd have to have assets to show that you can carry the loss.
0.75. Okay. So they're negative like 25 on the dollar.
Yeah, yeah. I mean, which is basically you're just taking into account Fannie Mae underwriting on how they look at rental properties. They take 75% of the value, right? So we're going to do the same thing. We're going to take 75% of the value and say, yeah, you're underneath, but you're still above Fannie Mae's guidelines.
Well, the DSCR, I think it's gonna make a comeback.
It has to, because what happened in the market was when we had the refi boom.
Yep.
Everybody first was focused W2 borrower, W2 borrower, W2 borrower, right? Just to get the volume in the door. But then when it came to refinancing self-employed borrowers that had multiple finance properties, that's when the mathematical equation came into play, where you were looking at the ability of the broker knowing how to do their REO section. And then if the underwriter knew how to do the REO calculation properly, or your third party offshore processing team who's importing the data. So that's why they flipped it over to DSCR, where it's just on a one-on-one ratio. Yeah. And like what I tell my brokers, like when they don't understand it, I tell them straight out, I'm like, a DSCR is nothing more than a VA IRRRL on an investment property.
On a what? Say that again?
It's like a VA IRRRL on an investment property. There's no income, there's no employment. All you're putting on the 1003 is your primary residence and the subject property that you're going to refinance. And we're just going to look at those two things. That's it.
Mm-hmm. Mm-hmm.
So once you actually start putting it in verbiage that they understand, all of a sudden the light bulb turns on and they're like, oh, wait, I got 3 more coming in for you. Oh, wait, I got 4 more coming in. So it's building traction, even with the interest rates being as high as they are.
Yeah. Well, like the deal, like those loans, the volume went down almost. There's a lot of displacement, so there's a lot of people who are scrambling to try to still see who's doing DSCR loans, like who can I get a loan from? Because like if you think about it, it got whacked on both ends. The prices for housing went up, right? When the prices go up, DSCR goes down. When the interest rate goes up, DSCR goes down, right? Mm-hmm. So like those are the two things that we just got whacked on both ends across the nation for the most part. So that's why the volume obviously came down, and now it's like it's maybe looking at options like a 5-year interest only or something is good.
Yeah, we actually offer a 10-year IO on them, on a 30-year and a 40-year. And the thing that's good with the DSCR is we can actually qualify them using the interest only payment because it's a non-TRID loan. So.
Yeah. Well, thanks, Well, thanks for the insight.
Yeah,
it's
no
good
problem.
Because you're in the thick of it too.
Yeah, I'm telling you, we got one right now that just came in. It was a fallout. We're trying to clean it up. We have some title issues. The VRBO documentation's all over the place. But I mean, the property's like 4 houses away from the beach in Kailua Kona. The thing's making $19,000 a month in rental income.
But I mean, how much is the mortgage payment though?
The mortgage payment's actually not that big. Let me see. Hold on, let me go into my system.
Yeah.
Actually, no, they didn't choose interest only.
Oh, okay.
They chose the regular 30-year fixed, $980 loan amount.
Oh, okay, that's not that high. I mean, for $19,000 a month, that's not high at all.
Yeah, exactly.
That's a great deal.
Yeah, the guy rents across the street, but he was smart enough to know that the market was changing. So went and moved in across the street and started doing VRBO and Airbnb for the last 2 years.
Those always spook me because you never know with the regulation, when they're gonna come, come knocking on that door, like your door. But
yeah, Kailua Kona has their own short-term rental regulations. Every single county has their own regulations on the permitting website. And you can literally pull up the list of every approved STR in the neighborhood and the ones that are on the naughty no-no list. And Kailua Kona, I think that property is fine. I mean, I've done so much research on it. He's been doing it for 2 years. And they're right now, the counties are extending the regulation, the Prop 41, where it's no longer coming into effect in October, but they're actually pushing it back to April of 2023. So what I'm telling people is like, you know, right now is a really good time, especially if you have a short-term rental and you know it's not in a designated short-term rental area. Who cares what the interest rate is? Cash it out, take 0 prepay, make your 7 payments, and then put it on the market. So you have that extra cash flow in your pocket for incidentals. So
yeah, that might be a good advice for someone in that situation. Because I've learned my lesson in that state. You know, I had to deal with my share of building managers.
yeah. And you know,
like,
every state has different regulations. I think I was helping one of my AEs the other day, and I don't know if it was Georgia or Colorado, but their STR regulation says you can do an STR, but the STR has to be on your property, which makes it no longer eligible for a DSCR because it's technically a primary residence, right? So yeah.
Right. Yep. Yeah. That's the hard thing. It's like one thing, you can find the deal, but you still gotta find the financing for it, unless you or if you have cash. But even if you have all cash, maybe how many deals can you really do if you're using all your own cash? So yeah.
Well, that you know what? That's what the realtors are doing with us, is the 1099 program. They're using the 1099 program, 90 cents to the dollar, cash out their primary, and then go buy investment properties that they know of in the neighborhood that are good deals.
Mm-hmm. Yep. Actually, didn't you have someone doing that? Oh no, that was a reverse 1031.
I have a couple people. We just closed on a couple 1031s last month, and we have someone who's wants to do a reverse 1031 right now. So I'm trying to find them something.
Thank you, Aiden, for you and Carl, by the way.
Yeah, they were driving for dollar calls, and they accidentally reverse prospect the wrong house. And it was the house.
That's a great story.
And
maybe let them tell it if
please do.
If you're on. I think Carl's in the office.
Oh yeah. No, that one was funny. We were just doing a driving for dollars list that Carl hit in Mount Willie, and I love doing cold calls. So I called up what I thought was a distressed property, and I was talking to the person. I was like, yeah, you know, we get a list of properties in the area that might need some work, that'd be hard to sell, because they said they're interested in selling. And then Carl was like, yeah, it needs a new roof. So I was like, yeah, it might need a new roof. And they're like, no, the roof was just replaced and doesn't really need, the inside's a little outdated, but it's still really good condition. And so I was so confused, but we had a 30-minute call and they wanted to sell. And then, so I was like, well, it doesn't make sense for a cash offer because, you know,
retail.
I don't want to lowball them because they have a great property. So after the call is when I figured out, Carl's like, oh, I gave you the wrong address. And so we just happened to call someone who was looking to sell, and they weren't really working with a realtor yet. And so I was able to refer them over to Ashley, and I think they had a good call.
Yeah, I was going to give you an update. Thank you for wins, deeds, needs, and good. That rhyme.
Needs, deeds, good deeds.
Yeah, that was.
It's only been 2 years.
It. And she actually did have a realtor that they were working with, but they lost out on a couple properties they really wanted because their agent didn't know how to structure a reverse 1031 offer. And so they lost out on, and they were really aggressive with their offers, and they lost out on a dream home and a second one they really enjoyed. So they were very happy to have been connected. And I really appreciate it too, because I think she wants to be friends.
Ashley just saw, what's the equivalent to a bromance?
A she-mance?
She-mance?
Doesn't have the same name.
Hermance?
No. Yeah, Hermance. It was a Hermance moment.
Oh yeah.
There was a lot of
guys,
emotion.
You guys might have brokered a deal and a lifelong friendship. Man, we gotta have like the end of the year coffee talk needs. Wait. Leads needs a good
didn't even know it.
Award. Anyways, yeah, the guys are out. Like, you know, like I always, my vision for everyone here on the team, on our team, is like, we're not just here to do loans. You know, you're not just a loan officer. You're not just a processor. Like, we're investors too. We're entrepreneurs, and you know, let's go find deals for our clients. So that's what they're doing right now, and we're gonna be diving face first into with a lot of help, you know, with Ashley's team, partnering with Ashley's team, building out our team. We're gonna start going in and trying to get some deals, you know, for all of us here on the call. Try to do this right. So stay tuned. But
he's got big plans for that. I want to just say too that the culture that groups like this cultivate are so important, and the like-mindedness of it. Like, I know the agents on my team definitely feel a difference in like a true abundant, you know, group, and that same thing is here. And when I was talking to that lead, for example, and I said, honestly, there is an inventory for what you're looking for, but if you do drive by and you see something, send me the address and I can reverse prospect there. I can get their phone number and try to get a hold of them. And you never know. And she's like, yeah, but does that ever really work? And I was like, I'm on the phone with you right now because someone did it with you. She's like, oh yeah, that's true. And I was like, and that guy, the people who contacted you, they are from a company and a culture that just gives, and they just, you contact, and I just contact them and I just, hey, your house looks, you know, like it needs some love. What's going on? Do you need anything? If I can be a part of that and, you know, play a role in helping that, everyone to get to that point and make that happen, didn't do it with an agenda in mind. If they get something out of it, great. If they don't, they're just seeking to help and connect one another. And she's like, wow, that's so true. She's like, that's really exciting. I never thought of, you know, the decisions or the actions that way. So I mean, that was part of the Hermance that was being formed, for sure. But also just to end the call with, this is a really amazing group of people, and everyone on here is just so abundant and supportive of one another. And that's really special, especially in a world like investing or real estate.
Yeah. Well, thank you. Yeah, that actually, yeah, we should all be very proud of that, because some of us have been on here since the first call. I don't know, we're on call like 102 or something like that. I told Kiko, I was like, oh, Brad, did you realize we passed 100 like calls? And he's like, oh, really? I was like, yeah, I didn't even know, you know.
None of us are on the 100th call either.
I found out on the 100th call. I think I was like, wait, is this our 100th episode? Because it said 100, you know. I was like, oh man, Kiko wasn't even on the call. And it's like, what else? The most important thing is that we come here, we build friendships from like across the nation, people even internationally. So like this is awesome. This is what it's all about. And we live that go-giver spirit. And we also kind of almost demand that of our colleagues and our friends that we surround ourselves with, because I mean, that's what we're doing this for. We have the freedom to choose who we get to work with. And like Daniel was alluding to, and Ashley was, you know, talking about, is like, you know, if things change and the market turns, the guys who are going to be successful in any business, any venture, any industry, because they're high performers, you know, to your core, they're gonna be successful either way. Yeah, and it's because they got that it factor, right? And this is becoming more and more recently to me. Like I usually notice like themes in my life of lessons that are trying to be taught to me. And this next one was, first it started when I had the pleasure of being on Tristan and Kamahai's podcast, and they asked me, what do we look for when bringing somebody on the team, right? And as I was answering that question, I started to realize, I actually don't know what I look for. I don't know what makes me decide yes or no. And until I really started to think about the question more and more, and I realized it's an intuition about a person, right? And that sounds kind of scary. It's like, okay, so your hiring process, when you're so protective of your culture, is your intuition, your gut feeling. That seems a little reckless, right? And it did feel reckless when I was at, I realized, what, it is kind of all I do is I just check my gut feeling, whether or not I like this person, if I can work with them, could I trust them? I think. And what I found out is that it's not it is my intuition, but the reasons behind my intuition are the little things that collectively form that intuition, which is when I meet somebody, from the moment I lay eyes on them coming in, right, I'm already checking boxes. I realize, like, do they hold themselves high? Are they intentional with their words? Are they kind of lazy in their chair? Like, there's a difference between being comfortable and just being lazy, right? Are they attentive? Do they make eye contact? Can they hold eye contact? Or what type of questions are they asking? How do they answer my questions? And I didn't realize I'm doing this, and I'm sure all of us do this, but all that little things, right, adds up and forms an intuition for me. And then ultimately it's like, okay, this is a good person. So now I feel it's not reckless, because my intuition is an answer. I'm getting an answer from all the little intangible things that we do subconsciously, probably, that show who we are, and it goes down to your emails too. If you just forward shit or copy paste shit, to me, it's like, okay, that's kind of lazy. Oh, you just forwarded me something with no content, so I got to go dig through all the threads and I got to figure it out. Like, the little stuff like that makes a difference, and in times where there's a clearing of the field, or there's a purge of the industry, right? And there's a reallocation of capital or business or deal flow, it's gonna go to those who are the high performers and have the little details. The ones who pick up the phone and call the realtor and take their temperature first before throwing them a low ball offer. It's the ones who maybe put a little synopsis before they forward. Could be the ones who are considerate. Like, those guys are gonna get ahead, because you have to be a high performer. You have to have those tiny details in order. Being considerate. So, anyways, that was a rant, but it's because, like, it's been a constant lesson I've been learning, and I'd love to share it to you guys, because I think that's really what is the difference between a high performer and just your average Joe. And I don't think any of us come on our calls every Friday for over an hour sometimes to be average. Like, I don't think anybody's here just to fucking be average, and I don't think so. So, like, let's pay attention to the details, because that's what gets you deals. Like, we talked about this before, right? Many times. The reason why, like, Ashley's representing me, the reason why when we would go on, like, buy properties on market in the heat of all the competition, and we don't have the highest offer or the best terms, why would we win contracts? Because of all the little details like that. Ashley doesn't just submit the offer. Those realtors are not gonna have a place to play when the volume shrinks, which it already is starting to shrink. They're gonna get weeded out. There's no room for laziness, in those times. And you're like, your realtor's job is to sell you. It's to sell you into a deal, and it's to sell the property into having new homeowners, have that home and live hopefully happily. So that's just my message. It's just if things start to constrict, really only the guys that belong here are gonna be able to play. And or more every Friday to be here. We care about our growth and stuff. So I hope everybody has a great weekend. And if you need anything, please reach out. I will try to post videos from the conference in Keiko Exchange this week. And I hope if anybody does need anything, you know, that they're not ashamed to reach out to us, because we have a lot of resources, a lot of smart people on these calls every Friday. You know, just because someone doesn't unmute doesn't mean that, you know, they might want to do business with you. So thank you guys for showing up, and we'll see you guys next week. Aloha, everybody.
Aloha. Thank you.
Good to see you,
Thanks.
Matt. Hope to see you around, man. Thank you for putting your input. It's great.